Do you want to know how to make money by doing absolutely nothing? Welcome to the world of dividend investing. I'll run through the essentials of dividend investing to help you on your wealth building journey. Dividends are a way of earning passive income. They are a portion of a company's profits that are paid to shareholders in exchange for investors holding onto stock without selling shares. People love dividends because not only do you get paid for holding onto stock, but it is also a means of watching the value of your shares grow if invested wisely. Dividends can be accepted in multiple ways. The most common way is through cash, in which a company pays money into the investor's preferred bank account. Another way dividends can be received is through what is called a DRIP method, which stands for Dividend Reinvestment Plan. This method pretty much reinvests the money back into the company, and the investor is rewarded with a fraction of the company's shares that equate to the amount invested. This method is preferable for those that trust in the long-term growth of the company. Who exactly decides how much to pay, and how might we be able to determine whether this is a sustainable option? First off, let's look at the sustainability of the dividend. This is predominantly determined through the payout ratio, which is a percentage of a company's earnings paid out as dividends. A healthy payout ratio generally ranges between 30 and 70%. The dividend yield, which is how many dividends are paid, is often decided by the head of the company and can change per year. The reason a dividend yield might change could either be due to affordability. However, if the payout ratio of the stock is too high, it could mean the company is only paying dividends to incentivize investors to buy shares, which if proven successful would be readjusted to a more affordable rate. When evaluating dividends, it's best to know some key terms, and I'll start this off with the dividend yield. This is depicted as a percentage and showcases the number of dividends paid yearly. An example of this being that if a stock price is $100 and the total amount of dividends paid for the year is $5, then the dividend yield would be 5%. Next, we have dividend payout ratio. As addressed previously, the payout ratio is used to check the financial health of a company and whether or not they can afford paying out the distributions. A low payout ratio depicts affordability and can pay the dividends to investors without much worry. However, a high payout ratio showcases that not only are they not in a position to pay a dividend, but may also raise a red flag in the case that they aren't using the funds appropriately to grow the business. Dividend dates are also an important factor to know about, such as the expiration date. This date is important to know because if shares are purchased on or past the expiry date, dividends won't be paid out until the next announcement, taking into consideration that the shares are held onto for that long. There is also the well-loved payment date, which is the date in which the dividends will be paid out. This date doesn't necessarily need to be on the same day as the expiry date and may take up to a month or so for the payment to be made. Dividends may also be a way of inflating share price, which is why it would be a good idea to invest in the company prior to the announcement date. Because once the dividend is paid out, there may be a high influx of selling of the stock taking place as the rewards have already been reaped. On top of this, the presence of a dividend payout may have the adverse effect, where shareholders stay invested in the long term and not sell, which may cause further individuals investing in the stock and sticking it out through market downturns to receive a stable income from the stock. One of the good things of owning a dividend paying stock is that if the share price dips a little, the dividend helps offset that drop in price. An example being is if a stock pays a 4% dividend for the year and the price drops by 4%, you can feel rest assured that there was virtually no loss. Or even if we go the opposite route, say the share price rose by 2% and the dividend yield is 4%, that's almost like having a 6% profit, making the way of dividend investing all the more attractive. Generally speaking, although there may be companies that try and manipulate investors with attractive high dividend yields, for the most part, dividend paying companies that act appropriately are an indication of a strong financial foundation, alongside a deep history of profitability. Although dividend stocks may seem appealing due to the immediate access to cash during payout periods, there may also be an argument to be made for growth stocks that reinvest that same cash into the business, which is that the company is seen to be more attractive in the long term, as the reinvested cash may allow the business to not only innovate, but also take on more debt at an affordable level, leading it to expand operations further than they otherwise would have if they didn't reinvest. Investing in a dividend paying stock or a growth stock is purely dependent on your financial risk tolerance, as a dividend stock, if evaluated properly, is seen to be more stable, allowing for more moderate growth with little need or worry or concern of stock performance, as a steady income is made anyway through dividends. making it suitable for any age group. However, a growth stock is a lot more volatile and is often subject to the risk tolerance of a more younger generation between their 20s to 30s. Or one might opt for a more balanced approach and adopt a strategy of investing in both dividend and growth stocks. Dividends, although being an amazing factor at play in the investment world, isn't always a pro, depending on what an investor is after. For example, if an investor is solely focused on seeing the price of the stock rise, it would be more preferable to go for a growth stock, as in a dividend-paying company, the money used to grow the business is instead used to pay shareholders. Another negative of dividend investing is that dividends aren't always set in stone, and during a severe downturn, company may slash their payments by either lowering the amount being paid out or even completely ending any dividends being paid out entirely until the company becomes stable once more. Opportunity costs may also play a big role when considering dividend-paying stocks, as it can cause investors to overlook alternative stocks that may prove to be more profitable in the long term. As well as this, if the dividend and the value of the company isn't growing as much as it should, then this may cause it to be affected by inflationary pressures. When there are uncertain times and the market experiences a downturn, a dividend-based portfolio may be the exact kind of security investors might be looking for, as these types of holdings are generally quite safe to hold and less volatile, as those holding the stock are less likely to sell during a bear market, as payments tend to balance out any visual loss that may be taking place. On the flip side, when there is a bull market and investors are optimistic and the market is in an upswing, then not only do shareholders gain through derivatives, but they also see the valuation of their holdings rise in value. One thing to be wary of during a bull market is that it may cause transactions being made which are at a premium price due to the fear of missing out on potential profits. In a bite-sized summary, dividend investing is a means of earning passive income without really doing much. It is a great and safe way to start on your investing journey for financial freedom. One key takeaway is to not fall for the dividend traps, which are companies that pay a high dividend yield that they can't afford. Always be sure to check out the payout ratios. And that being said, I hope this video has been informative, and please leave a like, comment, and any ideas you might have or anything that I might have missed.